Imagine if your business could get the cash it needs but only pay a low, steady rate at first and then switch gears to something totally different. Hybrid business loans do exactly that, and most business owners have no clue they exist. What is a hybrid loan for a business? Why are so many companies now choosing these over traditional loans? Put simply, a hybrid loan is a financial tool that blends the best parts of multiple loan types so you get flexibility and stability all in one package. Think about a hybrid loan as a best of both worlds scenario. For example, instead of being stuck with just a fixed or just a variable interest rate, a hybrid business loan might lock you into a predictable, fixed rate for the first few years, then switch to a flexible variable rate later on. Why is this important? In the early stages, when every penny counts, you know exactly what your payments are, which makes cash flow planning way less stressful. Then, when your business is more established, you get the chance to benefit from potentially lower variable rates. Is this only for big corporations? Absolutely not. Small business owners, startups, and even growing family businesses are turning to hybrid loans. The reason is simple. Hybrid loans can offer access to larger sums of money with more manageable repayment terms than many standard business loans or lines of credit. How does a hybrid loan actually work in practice? Picture this. Your business is expanding, but you do not want to give up equity and you need funds to cover a major project. With a hybrid loan, you might draw the amount you need, pay interest-only payments for a set period, say 6 months, then switch to regular principal and interest payments just like a traditional loan, but at a fixed rate for the next 5 years. Are there any other forms of hybrid financing? Yes, and this is where it gets creative. Some hybrid loans combine not just different interest rates, but even mix debt with equity. For example, you get a loan, but the lender also takes a small stake in your business. This way, you retain most ownership, yet get the capital injection you need to grow. What are the real advantages? Hybrid loans can help manage risk, especially for startups who face unpredictable revenue. You avoid handing over company control, and you might negotiate terms that are more flexible than a rigid bank loan. Who offers hybrid loans? Many banks, online lenders, and even some venture capital firms are now offering hybrid products. They might call them step-up loans, blended rate financing, or convertible debt, but the idea is the same. More options, less rigidity. Are hybrid loans risky? Like any loan, they come with pros and cons. The switch from fixed to variable rates could mean payments rise if interest rates go up. But for many, the initial stability and long-term flexibility outweigh the risks. When should you consider a hybrid loan? If you expect your business to grow, want to keep ownership, and need a flexible structure, hybrid loans are worth a close look. They are especially powerful for businesses with seasonal cash flow or unpredictable income. Need a real-world example? Imagine a tech startup launching a new product. They secure a hybrid loan, pay only interest for the first 6 months while building inventory, then start paying down the principal once sales take off, all without losing equity. Because hybrid loans allow your organization to unlock new funding opportunities without giving up control, the next video reveals how to get a loan for a church building even if your congregation is small or your financial history is limited, so you can take your vision to the next level.